Hello friends, today we will discuss in this video why the interest rate was reduced on June the 5th and what is going to be the impact of this change. I'm sorry I could not make this video earlier as I was on a vacation and I just came back. So here we go on this new video. As you all know that we are running a promo that when we reach 2000 subscribers, we will pick one name from the list of subscribers and the winner will get $250 Costco gift certificate. The name of the winner will be announced on this channel. And I want to thank you very much for the super success of my last few videos, friends. Especially the two videos on the luxury home in Ontario and the financing of the luxury home in Ontario. Combined, I got over 17,000 views from you guys. Thank you very much for the overwhelming support. I'm really overwhelmed with the super success of these two videos. Also friends, I want to reiterate that since you are watching these videos in that numbers, just hit the subscribe button. Your name will be drawn for a $250 Costco gift certificate when we reach 2000 subscribers. And now we start today's topic. As we were anticipating for the past few months, you know, and I was confirming in my previous videos and my radio interviews that the rate of interest in Canada would go down by 0.25%. Exactly the same happened. The Governor of the Bank of Canada, Tiff Macklem, reduced the overnight rate of interest in Canada from 5% to 4.75%. This is a 0.25% reduction. This 0.25% reduction came after a very long time of rate hikes. This decision marks a significant shift in the central bank's monetary policy, aiming to bolster economic activity and address growing uncertainties. This is the first rate cut since the pandemic-driven economic crisis, signaling a proactive approach to counteract potential economic slowdowns. Now we expect the BOC, the Bank of Canada, isn't done yet, he said. We have the central bank cutting twice more in 2024 at least before continuing the cutting cycle throughout 2025. And here is the brief history of the Bank of Canada's interest rate hike and lows. For a very long time during the COVID-19 pandemic, the Bank of Canada left its overnight lending rate at 0.25%. However, in March 2022, amidst rising inflation and the outbreak of a war in Ukraine, the Bank of Canada raised its interest rate 25 basis points to 0.5%. Over the following year, the Bank of Canada raised its interest rate several times in an effort to help combat rising inflation, culminating in July 2023 when the overnight lending rate hit at 5%. The Bank of Canada held the rate until today, that is June the 5th. With continued evidence that underlying inflation is easing, the Bank of Canada's Governing Council agreed that monetary policy no longer needs to be as restrictive and reduced. The inflation right now is at 2.7% as of April 2024, which has dropped from an overwhelming 8.1% in February of 2022. Now, recent data has increased our confidence that inflation will continue to move towards the 2% target. Nonetheless, risks to the inflation outlook remain. Governing Council is also closely watching the evolution of core inflation and remains particularly focused on the balance between demand and supply in the economy, inflation expectations, wage growth, and the corporate pricing behavior. The Bank of Canada remains resolute in its commitment to restoring price stability for Canadians. Eventually, the Bank of Canada's interest rate policy has an impact on the rate at which all Canadian banks will lend money to businesses and individuals, which includes mortgage rates. As a result, the prime lending rate, which on June the 4th was 7.2%, has now dropped to 6.95% on June the 5th. Now, what does this rate decision mean for Canadians? Now that the Bank of Canada has made its first change to its overnight rate, homeowners with a variable rate mortgage could see more of their money going towards the principal amount on their mortgage and less towards the interest. That means a homeowner could possibly pay off their mortgage faster than in a higher rate environment. For homeowners on a fixed rate mortgage, this rate may cut not be very helpful but might not ease all affordability concerns because their mortgage is already locked in at whatever rate, but the cost of living apart from the mortgage is going to be helpful for them as well. Now, even if the interest rates are starting to come down, people who have fixed rate mortgages that are up for renewal may renew at a rate that is higher than what they had before, especially if they secured a mortgage during the thick of pandemic when the interest rates were at historic lows. The rate situation in 2024 is different than it was a few years back. Now, while there was some speculation that the Bank of Canada might hold off on cutting its overnight lending rate until July, the central bank opted for a cut. The Bank of Canada's decision could have big implications for the Canadian housing market, especially if further rate cuts arrive later this year. Many Canadians, especially the first-time home buyers and existing homeowners looking to renew their mortgage, have been watching the central bank's rate decisions carefully as they affect the rate at which Canadian banks can lend money for loans like mortgages. Now, because the Bank of Canada's benchmark rate serves as a reference point for the interest rates that financial institutions charge to their customers on products such as mortgages and loans, the Bank of Canada's decision means that people with variable rate mortgages that fluctuate with rate hikes or cuts could soon start to see some kind of financial relief. Well, I believe that the Bank of Canada did not want to wait any longer to cut the rates. This was the right time and has signaled millions of people in Canada who are holding to buy a property. Now is the time, and the rate of interest will further keep going down, at least up to 1% total this year and approximately 1% more in 2025, and looks like will continue in 2026 as well. Now that the Bank of Canada has opted to make a cut to its overnight lending rate, all eyes are on the central bank's next scheduled announcement about its interest rate, which is scheduled for July the 24th. And this rate cut, as I said, is just the beginning of a larger trend from the Bank of Canada. Friends, if you're liking this video, please smash the like button. It will help the YouTube algorithm and ultimately this channel as well. Coming back to the reasons for the rate cut. The decision to reduce the interest rate comes amid several economic challenges. Chief among them is the sluggish growth in the domestic and global markets. Recent data indicated that Canada's GDP growth had been slower than expected in the first quarter of 2024, with significant contractions in key sectors such as manufacturing and retail. Now, inflation rates have also been a concern. While inflation had peaked earlier in the year, it has since shown signs of moderating. The central bank aims to ensure that inflation remains within its target range of 1 to 3%, and the rate cut is part of its broader strategy to manage the price stability in Canada. Additionally, the global economic outlook has been clouded by uncertainties, including geopolitical tensions and trade disruptions. These factors have collectively contributed to a more cautious economic environment, prompting the Bank of Canada to take preemptive action to support the growth. Now, coming back on what will be the impact on Canadian economy of this rate cut. This reduction in the interest rate is expected to have several immediate and long-term effects on the Canadian economy. Stimulating borrowing and spending. The lower interest rates typically reduce the cost of borrowing for consumers and businesses. This can lead to increased spending on goods and services, thereby stimulating economic activity. Home buyers in particular may benefit from reduced mortgage rates, potentially revitalizing the housing market. It also encourages investment. Businesses may find it more attractive to invest in expansion and new projects due to lower financing costs. This could spur job creation and innovation, contributing to overall economic growth. Also adds to currency depreciation. A lower interest rate can lead to a depreciation of the Canadian dollar. While this makes imports more expensive, as I have discussed in my previous video as well, it can also boost exports by making Canadian goods and services more competitive on the global stage. This could help narrow the trade deficit and support domestic industries. Now, the financial markets responded positively to the rate cut, with the Toronto Stock Exchange experiencing a notable uptick in the days following the announcement. Investors seemed reassured by the central bank's commitment to supporting the economy, despite some concerns about the underlying reasons necessitating the rate reduction. However, not all reactions were favorable. Some analysts cautioned that the rate cut might signal deeper issues within the economy that could require more than just monetary policy adjustments. There are also concerns about the potential for increased consumer debt levels, as lower interest rates can lead to more borrowing. The Bank of Canada's decision to lower the interest rate underscores the complex balancing act central banks must perform in navigating economic challenges. By reducing the cost of borrowing, the central bank aims to stimulate economic activity and maintain price stability amidst a backdrop of global uncertainties and domestic economic concerns. As the effects of this policy shift unfold, stakeholders across the economy, from consumers and businesses to investors and policymakers, will be closely watching to gauge its impact on Canada's economic trajectory. Now let's discuss what will be the impact of this rate cut on the Canadian real estate sector now. Well, this decision by the Bank of Canada to lower its benchmark interest rate by 25 basis points to 4.75% is poised to have significant implications for Ontario real estate market. As one of Canada's most dynamic and diverse real estate markets, Ontario stands to experience a range of effects from this policy change, impacting buyers, sellers, investors, and the broader economy. Now, lower interest rates generally translate to reduced mortgage rates, making borrowing cheaper for prospective home buyers. This reduction in financing costs can lower monthly mortgage payments, making home ownership more accessible to a broader range of buyers. In Ontario, where housing affordability has been a pressing issue, this could lead to increased demand for homes. Now, the first-time home buyers in particularly are likely to benefit from this rate cut. With the lower mortgage rates, the barriers to entering the housing market are reduced, potentially leading to a surge in home purchase applications. This increased demand could drive up the home prices in the short term as more buyers compete for available properties. The reduction in the interest rate also is expected to spur overall activity in the housing market. Sellers might find it easier to attract buyers, leading to quicker sales and potentially higher sale prices. Real estate agents and brokers may also see increased business as both buying and selling activities pick up. In the condominium and the townhold segments, which are popular among young professionals and small families, this rate cut could result in heightened interest and faster turnovers. Similarly, the market for detached homes, which has seen significant price appreciation over the years, might experience renewed vigor as financing becomes more affordable. Now, the lower interest rates can also make real estate investments more attractive. Investors looking to purchase rental properties or engage in real estate development may find it more feasible to finance their projects. This could lead to an increase in supply of rental properties, potentially stabilizing or even reducing rental prices in the long term. Additionally, the lower borrowing costs might encourage more foreign investment in Ontario's real estate market. International investors, attracted by the relative affordability of borrowing and the stability of Canadian economy, might contribute to increased demand for high-end and commercial properties. The impact of the interest rate cut on the Ontario real estate market is likely to extend beyond just the property transactions. Increased activity in the housing market can stimulate related industries such as construction, home renovation, and retail, especially for home furnishings and appliances. This can contribute to job creation and further economic growth in the province and Canada as a whole. Moreover, as more people purchase homes, there might be increased demand for public services and infrastructure, leading to potential growth in municipal investments and developments. While the interest rate cut presents several opportunities, it also brings some potential challenges. One significant concern is the risk of exacerbating housing market imbalances. If demand significantly outpaces the supply, it could lead to overheating in the certain segments of market, driving prices to unsustainable levels. There is also the risk of increased household debt. Lower interest rates might encourage more borrowing, leading to higher debt levels among Ontario residents. Now, this could pose long-term risks to financial stability, particularly if economic conditions challenge and the interest rates rise again in the future. While, in the conclusion, I can say that the Bank of Canada's interest rate cut is poised to have a substantial impact on the Ontario real estate market. By making borrowing more affordable, the rate reduction is likely to stimulate demand, increase market activity, and attract investments. However, stakeholders must remain vigilant about potential market imbalances and the risk of rising household debt. As the effects of this monetary policy change unfold, Ontario real estate market will be closely watched by buyers, sellers, investors, and policymakers alike, all seeking to navigate opportunities and challenges presented by this new economic landscape. And I can predict, as I've already done it before, at the outset of summer 2024, this rate reduction will fuel consumers' sentiment, and people who have been holding back will come back to the fore to take advantage. This will also pump the refinance market. People who have been stuck with credit card debt and are on high rates on mortgages can now refinance and pay off the debt and make their life better. All this money that is saved from interest payment will go into consumer spending, and that will increase the GDP of Canada. Should you have any concerns or questions about this, anything you have to ask, my friends, please feel free to call me and we will discuss your concerns. Take advantage of this current scenario and save money for your family. When you call me, we will discuss how this current scenario will benefit you, and looking forward to hearing from you with all your queries. Stay blessed, be safe, and see you soon, very soon, in the next video with another topic. Thank you for watching.